yeah, I think we only realise, when we've lost something, what we had. And we used to be able to get loans very easily. And 80% of the purchase price, regardless of what you bought, whether it was buying a block of land, building a house, buying a unit, for a foreigner and an expat, 80% was available without mortgage insurance. We also used to get the same interest rate, whether you were owner-occupier, whether it was an investment property, whether it was principal and interest, and whether it was interest only. And interest only for investors was readily available up to 15 years. No problem at all. And the servicing assessment, it was, you basically declared your income, declared your expenses. In fact, you didn't really declare the expenses. The bank just kind of, if you were a single person, it's like $1,200 was your monthly expenses. Now they go through it, your bank statements. So the servicing, used to be able to borrow far more than you can borrow now. And most people used to go and buy a property before they'd even considered what financing they could get, because it was so readily available. People would go and buy 3 in one go, knowing that they could get a loan. Whereas now, it's essential that you get a pre-approval, or at least you have a servicing assessment done to determine your borrowing capacity. Because there's absolutely no guarantee these days that lending is available. Especially for foreigners. In 2015, all the Australian banks decided they weren't going to lend anymore to foreigners at all. And we had the Singapore banks still. But it was the only other lenders out there were the kind of what I like to call rip-off merchants, who basically were charging 8% interest and 3% to actually get a loan. I couldn't consciously promote those loans. But now we do have a couple of other options, which I'll go through in a second. The thing is now is that, if you blindly go and buy a property without getting, assessed for lending, if you need a loan, then your deposit is at risk if you can't settle. The other thing is, you might want to go and buy a property for $1 million, and you've got $200,000 available as the deposit. But if you can't get a loan of $800,000, you can only get one of $600,000. It's again important that you determine your borrowing capacity before you go and buy a property. Then, if you can only get a loan of $600,000, you just go and buy something for $800,000. And you also need to be mindful of the time to settlement, because it takes a lot longer now to get a loan. It's not like, just sign a piece of paper, give your pay slip, and there you go, there's the loan documents to sign. The banks now require so much detail, so much paperwork to get the approval. So basically, using somebody like us is essential, because we can guide you, we can basically determine the best loan for you, so that it goes through smoothly and you can settle. So in order to get a loan, you have to basically disclose your current financial position. So you have to declare all of your Singapore assets, Singapore loans, if you've got loans anywhere else in the world, whatever you've got, because the banks check now. They the couple of banks we have in Australia, they will do a credit check on you. In Singapore, to determine what you've got. So if you say, oh no, I don't have any loans in Singapore, and then they do a credit check and find you've got one, it's an automatic decline. They don't even want to talk to you after that. So it's important that you make sure you declare everything. As I said before, the servicing assessment is a lot tougher. The banks basically they don't use 100% of your income because of the currency exchange fluctuation, so they take at least 10% off, sometimes 20%. They do allow us to use Singapore tax rates, which is good, but for Australians, they use Australian tax rates. And then any loan that you do have, even if you've got a Singapore loan, you're paying 2%, they assess that loan at over 7%. So it just means that instead of, like you're paying $3,000 a month, it makes your payment $10,000 a month, for example. So it just means that, your borrowing capacity is reduced. But we can still use all of your Singapore income and the Singapore tax rates. So we do have a choice of Singapore and Australian lenders. Obviously, we all know the lenders in Singapore, and then we've got 2 banks in Australia now that will lend on sensible terms. So, up to 75% lending, between 4.5% and 5.5% on the interest rate. And the other option you do actually have is if you've got a Singapore property and you've paid it off, or you've got lots of equity in it, you can go and use that to borrow to get, pay cash then for the Australian asset. You still get the tax benefits on that loan. So even if you go and borrow $500,000 against your Singapore property, pay cash for the property in Australia, the interest on that $500,000 is still tax deductible against the income you're receiving on that property. The other thing is if you've got an Australian property, either fully paid or, again, with lots of equity in it, you can use that as security to go and buy the next one. Okay, now here we just got some lending terms for Australian lenders and Singapore lenders. As you can see, the Australian lenders, we can borrow up to 75%. For Singapore lenders, the maximum you're going to get is 70%. In actual fact, the interest rate, whether you get it from here in Singapore or in Australia, is very similar. It used to be you'd be able to borrow at 2% if you took a Sing dollar loan. Now the banks are charging, cost of funds plus a margin of at least 2 to 2.5%. And then the setup fees cheaper in Australia than it is here. And you do have a choice in Australia of having interest only or P&I, 3 to 5 years interest only. But again, here it's only P&I. Now, for construction finance and structures, the structures is when you buy in a trust or you buy in a company. So there's very limited option on that because the lenders that we do have don't lend for land and then to build. But we do have a lender whereby it's about 7, I think it's about 6% in year 1 and then it goes up, but the fees to get in it again are about 3% of the loan that you require. So it's very expensive. You're much better off if you want to buy a house to basically do a deal whereby the builder builds it and you pay a higher deposit and then you settle when it's finished. Okay, so anyone got any questions?